Good afternoon. This is Jim Barlow with OakTree Premium Finance. And I don't have these every week, but most weeks I have a presentation on my alchemy and made a few changes. I'm always trying to make it better and also trying to make it shorter. I think I'm about a half hour. We'll see how we go. All right. Um, Transforming life insurance into a powerful wealth building tool. For centuries, alchemists sought to transform lead into gold, unlocking wealth and enlightenment. Well, I'm the alchemist of leverage today. I'm going to show you how something really cool happens when you do this properly. I'm going to show you how life insurance can be transformed into a powerful wealth building tool. And I'm going to give you the tools to explore it so you can get every question answered and see how it can work for you. Welcome to the new alchemy of wealth creation. This strategy will give you more retirement income with less out-of-pocket costs. That sounds pretty exciting. It's going to be tax-free retirement income. There's going to be no market downside. Can't lose money. You're going to have protection. It is life insurance. And you're going to have living benefits, which includes long-term care, disability income, minimal financial disruption to your life, just 5 years of payments. Simple, low maintenance design. It's not something you're going to have to worry about. Creditor protection. You could use it as a strategic gifting plan for your family during life or at death, either one. You could use it as executive benefits and retention solutions, succession planning support, legacy planning, all with really, really low risk. I'm going to show it to you. My mission is to educate, challenge the conventional thinking, and empower you to use this strategy to its fullest potential. Who am I? Married Barbara Halls. We've been blessed with 7 children and 28 grandchildren. I graduated from BYU, where we remain devoted fans, and I worked as an investment advisor for 35 years. Our passions and values: we love to travel, we visit family, we enjoy family vacations, we read, we attend plays, and we really treasure all that time with family. It's important to us. We serve in the temple, we strive to be disciples of the Savior Jesus Christ. Above all, I want to do good. I want to help people. I don't want to quit helping people. So let me tell you about an alchemist. There's a book written, it's listed there at the bottom, by Janet Gleason, The Extraordinary True Story of the Invention of European Porcelain. The book is called The Arcanum. Arcanum? I guess I'm saying that right. Anyway, this is about Johann Friedrich Butcher. I think I'm saying his last name right. Guess I should talk to a German. Early 1700s, he was a young German alchemist, and he claimed he could turn lead into gold. In fact, he was an apprentice at this company, and one night, he, with his boss and his boss's friend, the two of them, he performed, we'll call it magic. And it looked like to them that he did turn lead into gold. But there's a little bit of magic. Anyway, 1701, Augustus the Strong, the ruler of Saxony, he imprisoned Butcher, he was 19, because he had heard about this turning lead into gold, and he was hoping to fund his entire empire through this alchemy. 1701 to 1708, under pressure, Botcher relentlessly experiments reflecting heat, blending minerals, testing clays, driven by a belief that something here could turn into gold. 1708, along with scientist Ehrenfried von Tershausen, I probably said that wrong. Botcher, now he's 26, discovers how to make hard paste porcelain, a secret only China possessed until then. 1710, they started the Meissen porcelain factory in Europe. 1719, Botcher died, aged 37, wow, pretty young, never having made gold, but remembered for turning clay into treasure. Fun book to read. I've read it a couple times. I probably should read it again. Anyway, The Alchemist. You know, alchemy is just looking for something better. It's happening all around us. We have the internet, we have smartphones, we have online banking, we have online retail business, we got Amazon, we got ChatGPT, self-driving cars. It's gonna happen. We're drones, biotechnology, gene editing. Oh wow, space exploration, SpaceX. These guys are alchemy. Is there going to be advancements in our society in the next bunch of years? Absolutely. Can we improve insurance? Absolutely. So, transforming life insurance to a powerful wealth building tool. We're going to blend life insurance, a growth strategy, and leverage, the borrowing, into a powerful alchemized approach for exponential wealth building. Some guidelines. It's life insurance. You have to qualify. You got to have reasonable health standard or better. There's an age range, too young and too old. It suits people with incomes of 200,000 plus. Contribution levels are 20 to 40,000 a year, depending on your age. And you need to give a commitment. This thing works if you keep it. That 15-year structured plan. It's amazing if you keep it. So life insurance, the first slice. Here's the 4 bullet points that I want you to basically understand. First, there's just the death benefit, financial protection for your beneficiaries, your loved ones. Everybody should be having life insurance somehow. And then living benefits. Not everyone's aware of this, but life insurance today, since about 1980, you can have riders of terminal illness, chronic and critical illness, long-term care. This is the reason for someone who's 60 or 65 should be buying things like this, for these living benefits to protect their assets as they're still around and using large amount of money. Living benefits, I really like that. Then tax advantage. The Revenue Act of 1913, this is when income tax began. And from day one, the federal government said death benefits to beneficiaries are tax-free. They also grow tax deferred. And how you can take advantage of this, you can do policy loans and not pay taxes. So that's the tax-free part. And last, there are life insurance costs, of course, but the investment advisory fees are not there. There isn't any. And the internal management fee is minimal. So that's the 4 bullet points of life insurance. If I put them in order of the ones I like the best, we'll go with tax-free first, living benefits second. I don't know about the third and fourth. Death benefits or the advisory fees, either one. And I threw this in a while ago, and above else, you got to know is protection, protecting your family, protecting your long-term care if needed, protecting your income if a disability strikes, whether it's illness or injury, is making sure things happen. I never want one of my clients to end up relying on a GoFundMe page because they lack the right protection. This is about peace of mind. This is about real security. And we're going to add these other things onto it in our alchemy. So we're going to summarize as we go. This is my summary page. We'll keep adding to that white space. So the three big deals in life insurance is you're reducing financial vulnerability because you got life insurance and living benefits. Then you're reducing tax risk, whether taxes are going up or not, because it's tax-free, and you reduce fee-related costs, long-term big deals. I'm going to use, for the rest, I'm going to do a hypothetical. I'm going to use a 45-year-old male, excellent health, non-smoker, annual income $240,000, retirement saving, he has $500,000 put aside, and he's willing to put $50,000 away per year for 5 years. And then he wants to get a retirement income starting at 65 and go through 95. With my software, I can select any dates for that, but 65 to 95 in my mind looks good. And there's regulated illustration rates that are permitted. And as of July 3rd, it was 6.45. I didn't check this morning, but I'm pretty sure it's the same. And I'm going to show the income tax rate of the highest. And I'm going to show long-term capital gain rates at 20 and state income tax 5.5. But we're going to show you how this thing works in a live situation. Oh, interesting trivia. The average age of people who buy this product is 46. And the average amount they put in per year is 70,000, actually more than this. So here's my chart I'm going to go with. We're going to show the beginning distribution at 65 and amount received through age 95. And if it has a death benefit, we'll fill in those others. But if you just do a after-tax investment at, let me back up, the 6.45%, keeping it fair for all options, then you could get an income starting at 65 at $37,699 for putting $50,000 aside for 5 years. And through 95, you'd have pulled out $1,168,659. If you did it in an IRA or a 401k, your income would have been $47,842. What is that, about $300,000 more? That's alchemy. By using 401ks and IRAs, you can get an additional $10,000 income per year. That other blank spot below, we're going to fill that in. You'll see it shortly. So life insurance. Now let's go into the growth strategy. Life term started in 1761, whole life 1842, and then something pretty exciting, index universal life in 1997. A long time before something this good. What you have in this index universal life that we use, you have indexes. You get growth and protection. The cash value grows in the insurer's account with index options providing potential gain without downside market risk. When the market has a negative 20, this has 0. And you do have some caps and participation rates, but I don't want to get into major details here. But a capped index might be capped at 12.5, meaning if the market does 13, you get 12.5. You're capped. Still, if the market is negative 20, you get 0, you don't lose anything. Or it might be a participation rate fund. And here you get a portion of the index. Now that sounds like it's less than 100%, but currently a lot of these participation rates are at 200% or 215 on some I know. So if you have an index that averaged 6% for the last 12 months, and you have a 200% participation, you'd get a 12%. And these don't have caps, so there's capped and participation rates. These things are very turnkey. This isn't something where you're going to have to be buying and selling and make sure you get the sale order in before the market closes today. This is very turnkey, very low management, no downside. So there's the growth side, but let me show you a little bit how this happens. So let's say we have $1,000 to go into the cash value portion of a policy. Well, in this example, a 5% interest market, 952 would go into the general fund of the life insurance company. This consists of high-grade bonds, and $48 would be available to buy options to replicate indexes. And that's exactly what they do. If the market has a negative year, your 952 returns to 1,000, you don't lose, but your $48 became 0. That's how you can't lose. If the market has a banner year, the $48 is going to go to $200-300 or something, or whatever it is. If the market's higher, or a higher interest rate, like 15%, then you're going to have more money going into the option budget, which means you can buy more in the market. So, and if it's a cap product, it would maybe have a cap of 13 or 12, 14 or something. And if it's participation, maybe you'll have a participation rate of 250%, because you have more money to buy more options. Interest rates going up actually helps index universal life. Still, with $1,000 in the general fund, protecting your principal. So here's the summary on the growth. No downside. Market link growth. You're going to get about market returns historically, and flexibility, reduced future liquidity and accessibility risk. It's just very turnkey. You don't need to worry about it. That's the growth part. So now we've took life insurance, we've done growth. Now we're going to add leverage to get this alchemized approach for exponential wealth growth. Let's change the subject for a minute. Mortgages. Before 1934, mortgages required 1/2 down and 1/2 repaid in 5 years. I wasn't alive then, so I didn't know that. Well, the history tells us that. But then in 34, the FHA created the 30-year loan, which revolutionized home buying. Before 34, 40% were able to buy a home. Today, 66%, a lot more. 85 million residential mortgages are currently outstanding, totaling 12.6 trillion. Buying a home with borrowed money has been a banner for our society and our country. What else do we use leverage, borrowed money for? homeownership, transportation, buying the car, everyday essentials, using a credit card, not a good idea. Education, student loans, healthcare, medical needs, if it has to happen. Major life events, starting and growing a business. Most businesses need this, have to do it. Real estate, no one pays rarely on cash for everything. So we use borrowed money, leverage in a lot of places in our society. This is some pictures I took in Cabo. Actually, I hired a photographer to follow us around this beach for a while and take some pictures. Some were pretty goofy, but I think these are some pretty good pictures of Barbara and I. And anyway, why are we not using leverage for retirement? It's a good question. We use it for almost everything else. Well, we can. Banking, borrowing or leverage up to 3 to 1. You know, banks, they leverage up to 20, 25, 29, 30%, 30 to 1. That's how come banks sometimes go under. This is 3 to 1. We found that to be the right amount and not too much. 5 annual payments or 16 monthly payments. Allianz allows monthly payments. National, just the annual. You can project. You can hopefully project 5 years. If you normally buy life insurance, you've got to project 20 and 30 years. And then trust ownership. We have a master trust, and our company we like to use is Provident Trust Group in Nevada, and they're the ones who take care of the leverage and do the work behind the scenes. So 3 to 1, 5 payments in a master trust situation. There's a bunch of additional features. Death benefit option B. There's living benefit riders, supplemental term, waiver of new charges, enhanced liquidity rider. We add a bunch of riders for protection and for this to work the way we want it to happen. I'm not going to explain all those today, but I can one-on-one, I'm happy to explain it to you. So here's how it looks. For the first 5 years, you make your 5 payments, the silver pigs. And the bank is approximately paying about the same amount as you are for the first 5 years. Then the last 5 years, I'm out of 10, there's 10 years of payments. You're done after 5, but the bank continues making their payments that they were paying, and they pick up what you are paying. So you can kind of visualize that 3 to 1. All without the typical risk of borrowing. There's no credit checks. There's no loan documents. There's no personal guarantees. There's no signature. There's no collateral. There's no loan. In ordinary premium finance, you do put up collateral, but not with our 3 to 1 in this strategy. So I've kind of given you a glimpse of it. How's it worked? The very first policy was issued in 2012. And I should have checked my internet to see if I could update this today. I didn't. Anyway, the very first policy is by one of the owners of the NIW who built and designed Kaizen. And she lets us see her annual statement every year. She's one of the founders. Anyway, the first policy issued in 2012. This was the June 26, 2024 statement, and so the 7.73. That's what she's averaged from 2012 to 2024. For 12 years, she's averaged 7.73 on her money. And then the borrowed money, she's averaged paying 3.81 interest. If you borrow money, you do pay interest. And so the spread on the borrowed money, she's been making 3.92, paying the interest, making 7.73, netting 3.92. So on her money, 7.73, the borrowed money, 3.92. The borrowed money is the big deal that allows this to happen and give you benefits as you can imagine. We did some back testing a while ago. Back tested this to 1930, 100 years. There's never been a 15-year period of time with less than a 2% spread. And we just showed a 12-year at 3.92. Never been a 15-year. Now, sure, those negative years in the market, when the market's negative 20 and you get a 0, you still pay interest. So your spread that year was a negative 3.81. And you're going to have even periods for 2 years that you're having lower, maybe lower than the 3.81, and so you don't make money on a given year. But all 15-year periods of time, there's never been less than a 2. So in my mind, I'm saying 2 to 4 on the borrowed money. And I mentioned the trust. So we have this master trust, and they're the ones getting the loan. And we have we actually set these up in a personal trust for yourself, and you're just assigning the trustee to handle it until the loan is all paid off. And that's how it kind of works in that diagram. So remember my numbers a little while earlier? Well, I want to show you, and I probably haven't talked about Kaizen very much, but the product is called Kaizen. But I'm going to show you the beginning distribution for this product using the illustration software. And did the the snare drum, so you can drum. Here's the result, and did a curtain call. And the Kaizen is approximately 90,000. Whew. That's a lot different. That's more than double the 37,699. Almost 47. Is that a double? Not quite, but almost a double from the tax-deferred IRA, 401k. And look how much income this person has had more from 65 to 95, 2,790,000 over the after tax. That's 1,500,000 more income. And we had initial death benefit of 1,400,000, and at 90, that illustration software didn't chunk it out at 95. You have a death benefit of 1,100,000, and this is tax-free. That 90,000 is tax-free net. Pretty cool. So we went a step further and did some stress testing on the 2 worst scenarios we have experienced. The Great Depression in the 30s. From 30 to 32, the stock market lost 70% of its value and did not recoup those losses until 1959. Whew. You don't want to invest in that kind of a world. Great Depressions, we're going to simulate 9 years of zero over 12 years to see how this thing does. And another bad area was the high interest rates in the 1980s, where rates got as high as 16.88. We're going to simulate high interest rates. does this product work in these two bad scenarios? Guess I could put another curtain call, but the stress test in the 1980s, 67,500, and the Great Depression, 58,000. Notice those 58s, another 10,000 over the 47. Even the worst scenario, you're going to be better than the tax deferred. 20,000 over the after tax. Amazing. Okay, yeah, they didn't have the results for how much income. So I got a curtain call coming. I got to show you. I'm getting out of whack here a little bit. Sorry. So what I want to do here is, what if you got double the 90,000? Allianz has done a study. They said, how good are their illustrations? And they came out and said there's an 80% chance that the 90,000 is going to be double than that. So you might be in the area of 180,000 income in this example, and a total through 95 of 5,580,000. 80% chance that the 90,000 is that far off. What a great opportunity. So protected on the downside with stress testing, and good upside with the borrowed money, the leverage. So that kind of fills in the blanks for the life insurance, the growth strategy, and the banking. Leverage, substantially reduced capital outlay. 5-year payments, reduced payment fatigue. Trust ownership reduces liability risk. And very turnkey, reduced management complexity risk. I love it. So we're getting close to wrapping things up. Oh, a little over a half hour. Darn, I'm sorry. In the investment world, they have a 7-point risk matrix. And number 1 is FDIC insured savings. That's low risk. Number 2 is is government bonds, very low risk. And the other spectrum, extreme risk, is cryptocurrency option trading, startups. Or 6, high risk, is private equity, speculative real estate. I left 3, 4, and 5 off. Where do you think Kaizen is going to fit? Let's show you. It's in the moderate to low, the number 3. Same with high quality corporate bonds, annuities, and then Kaizen. So it's low risk and big reward. Here is an important tool for you. The founders of Kaizen is NIW, Plano, Texas, and they built this landing page real recently. And you've got videos, you've got chapters about talking about the leverage. You can be spending a lot of time learning about these different pieces. And there's a QR code. You can go to use that QR code and go to this landing page. And there's no commitment. You're just looking around. They don't even know you're on the landing page. Nobody knows. I don't even know. So you don't have to give your phone number, email, or address or whatever. You know how that goes when you're looking at things online. You have to fill in all these little things. Well, you don't have to here. You can spend all the time you want learning. And they have a second page like that one. That one is kind of generic on Kaizen. This is if you're planning to use Kaizen to gift money to your kids or grandkids. I don't have a QR. I haven't made a QR code on this one yet. If you want to explore Kaizen with this, just let me know and I'll send you the link so you can look at this way. But this is going to be very educational too. These two things are really the most important to learn about Kaizen. In addition, I think my website is dynamite. There's the cover, and in the website, I've got a bunch of links on this page. I've got I've got a retirement calculator. I'll show you in a jiffy. A lot of different things you can go to. That very thing the QR code gives you. I built a basic retirement income calculator. This is free on my site a while ago, and it is really nice and simple. And I've got another one, a little more complex, I just barely put together. This will, you're putting in Social Security, you're getting everything on this one. These are calculators that will help you decide if what your gap is between what you have and what you're going to get. That's on my website. And that's it. What's the time? Oh, 6 minutes over. Anyway, there's that QR code to go to that landing page. There's my office phone number, my email, my website. If you have any questions, I can be of any help to you. I'm willing. I love what I'm doing. This is fun with all my other retirement stuff I do, but this is, I love being in business helping people. And with that, let's call it a day and see you next month for next month's webinar. Thanks for attending. Bye.